Good morning, everybody. My name is Kevin Uphill. I'm the chairman of Avondale Corporate, and welcome to our webinar, M&A Update 2021. Now, we're a small group today, and what we'd like to try and do, yes, we're going to do an update, but what we're really keen to do is also get your involvement through the Q&A and also sharing any experience that you may have. I'm going to be joined today by my colleague Tim Hardman. He's our Managing Director at Avondale, and he will also be sharing some of the trends and experiences that he has. So welcome, Tim. We got 50 minutes or so today. As I say, really keen to get to questions, but I am just going to give you a little bit of an update on what we see happening in the market right now, some of the trends that we see, and possibly trying to forecast some of the trends that we may also see. So 20 minutes or so on that, and then Tim will be chewing the fat with me and hopefully you guys on some questions, and that's really important as we go. So look, the backdrop right now, and we all kind of know this, it's really tough out there. GDP is still 2% lower post-pandemic than pre-pandemic. But interestingly, you all remember the sort of 2008, 9, 10 credit crunch and crash and the big dip that we've had there. Since that time, in the emerging economies, growth has been slower than the previous 40 years. So global growth over a 50-year period, 3.5%. In 10 years pre-pandemic, 1.9%. So barely beating inflation. So effectively, Western economies are flatlining, which basically in that scenario means it's very difficult to organically grow businesses, and M&A does quite well because it's a great way for people to bolt businesses together, create shareholder value. But of course, there's more risk because the economy is difficult and organic growth is harder. This one, we're 2% lower post-pandemic GDP, and hopefully we will catch up. But we all know it's going to be a tough one. It's a £400 billion bill, and the recent tax hikes on national insurance and corporation tax don't even begin to tackle that. So not only have we got slow growth being caused by aging population, but also, in my view, I think, the slowdown of the consumer economy due to environmental factors. We've also got massive debt issues resulting from the credit crunch and the pandemic. So all of that means that the politicians selling the growth dream is over. We have to expect pretty static environment and a very tough headwind for our businesses. That means people need to look at deals. And I think those of you who've seen our stuff before, heard of us before, Avondale specialise in what we call the emerging mid-market. So that's transactions between enterprise value 2 million to 50 million, really the sort of quality end of the SME business sector. So employees 15 to 200. And the main drivers that we see, apart from that slow growth, behind deals, and we call it the four corners of M&A, economies of scale, shareholder value, positive disruption, and synergy. So if we're profiling buyers acting sell side, we are looking for buyers that get all four of those. If you get all four of them, they'll pay a higher value. But also, as drivers to deals, they are the fundamentals to sort of deal value. Now, positive disruption is probably the strongest trade driver. Historically, economies of scale, so the whole, 1 + 1, we only need one MD, one FD, putting businesses together, has been a significant driver for M&A. But positive disruption is really important, I think. But also, as we're seeing, technology teams, there is lots and lots of money out there. Money does not guarantee success anymore. Fundamentally, ideas, intellectual property, positioning, brand is becoming more important because capital no longer guarantees success. So it's really important when people are looking at acquisitions to bear that in mind. So we are absolutely snowed under, which is really positive, and in recruiting and stuff. And that's because people want to do deals. And fundamentally, there's two factors there. One, the organic growth slowing, and therefore acquisitions driving it. But two, lots and lots of money looking for a home, looking for a yield, and that's pushing into M&A. It's kind of rocket fuel for deals. In terms of sell side, we are seeing a bit of a reset. I think there was very much a view pre-pandemic that sellers were of a mind that they weren't necessarily prepared to retire. Their business offered a good yield. They could work remotely, and so they were hanging on longer. But I think the pandemic, plus the potential tax rises, which we'll talk about in a minute, has focused some of their minds, and they are going, hang on a minute, there's more to life than just running a business. So we are getting the lifestyle seller, for want of a better word, coming back. I want to, retire to Spain or get the ski chalet. I'm going to go now whilst the tax breaks look quite good on a sale. Fundamentally, both buyers and sellers are optimistic still. Whilst it's really tough out there, we think that people genuinely know that you stay positive, you stay proactive, and that means doing deals. And of course, equities, you've seen that in the bounce in market equities on main listed companies. Yeah, ultimately after recession, optimism kicks back in and people just get going. And we're really seeing the signs of that now. It's really interesting. KPMG did a survey, which I have to say, I think got some question marks on, which is that 67% of leaders in corporates are going to use M&A to transform their business model. Now, for us, this is fascinating. Remember those four corners we talked about: economies of scale, synergy, shareholder value, and positive disruption. Basically, what you're saying is you don't, as a CEO, know how to change your business model, or you can't change it fast enough. So you're going to buy businesses in order to push that change ahead. And fundamentally, you can see here on the left, I've got this slide in. Who are your future customers? What are they going to be buying? What are the changes occurring in your market? So this is ultimately looking at your business model and deciding where it's broken and using acquisitions to create the fix. And I'm a little bit cynical, because whilst I hear the survey, we're not fully seeing that trend coming through from corporates at the moment. Most of our deals are private equity-led corporates. They are therefore businesses with a lot of capital built around the idea of acquisitions, very often buy and build strategies, whereas the corporates have been a bit shy so far to come back to the M&A table. So I hear the survey. It'd be really interesting to see whether those corporates really do go for it, even though they've got the money in the bank. My concern is that it's very easy as a CEO to maintain the status quo, and doing deals is high risk, and they don't like that. My advice to them would be, however, you've got to look at the line of probability. There are hundreds of instances where big corporates don't disrupt their business model, from the Microsoft IBM story to the Netflix blockbuster story. They don't disrupt their business model. They fail, therefore, to buy the higher risk business. But as a result of that, taking even bigger risks as their business model declines. So we'll see what happens. They're not yet fully come to the table as far as we can see. And I think that's also, leaders are still being forced right now from an operational point of view to look down. So again, with corporates, the big wrestle right now, getting people back to the office, for example. So yeah, you want M&A to come through, but it's not coming through just yet. In terms of the kind of recession that we're seeing, 2% drop in GDP was more, very tough environment. Of course, there are going to be value plays available. There are also going to be equity jet swaps as people realize that their balance sheet is exposed. You've got people with civil loans. In fact, I was talking to one yesterday. They've got a civil loan, they've got a funding circle loan, and they've got director's loan. So it's not technically insolvent, but yeah, balance sheet really highly geared. And I think people will be looking at that and going, yeah, is it right to stay independent? Can we stand alone? Having said that, because of the furlough scheme, but also the changes in legislation around liquidation and insolvency, that distress has not really hit the market yet. But obviously, with the furlough being pulled away, I think it's the start of it. So for acquirers, there will be value plays and possibly debt for equity swap opportunities. I would urge some caution. We did speak to actually, funny enough, he's turned into a potential seller, but he did a distressed deal last year. He's been looking to acquire 2 or 3 companies. He bought his major competitor in distress, and it's kind of worked because he's kept 1 or 2 really key customers. But what he did, you know, obviously looking at market share, he didn't spend any time looking at the quality of management. And of course, rule number 1 when you're buying, look at the culture, look at the people. Of course, you need to do the commercial due diligence, you need to do the legal due diligence, but in the end, it's a team you're buying, and he didn't properly do that. Went in, tried to change their outlook. He was, let's put it this way, pretty uncomplimentary about their skill set and ability. So he just hadn't done his homework. So closed it down, bolted on a couple of customers. It will pay back. But actually, interestingly, as a result of that experience, he's gone, well, hang on, maybe I'm not the acquirer, maybe I'm the seller. That's in the construction sector. That is really busy at the moment, and people are interested in that. So it could be a good call for him. That's a sort of strategy. You know, we've mentioned private equity are really, really very busy at the moment. So they're not wholly strategic acquisitions because they are funded companies that are out there being fueled mainly to consolidate sectors. So they are scale plays. But in terms of the positive disruptions play, you know, should you be buying for scale and economies of scale? Probably not, because they're one-off hits. But you should be looking at how the acquisition changes your market against where your market goes. And our top tip for acquirers is know yourself before you know others. We get a lot of people who have the mindset that, you know, we should go and talk to 100 people and something will come off. Our view on that is wholly different. I think if you get really clear on your own weaknesses and your own strengths, you know where your business is, then it's really very possible to look at ahead in your market where you may fall over, and then create your acquisition criteria around that, which would then narrow your market. And as a result of that narrowing the market, there you'd be in a position to identify just a few players. Again, really interesting. A massive corporate just this morning actually just reached out to us. We've got a LinkedIn potential seller on one of my profiles. They're a massive utility based business, but they don't have enough what I would call fit out people, foot on the ground, if you like, engineers. They've spotted that we're talking to one, and they've done their homework and research and on the company, identified it, and then reached out to us to say, should we talk? Now, I think that's really good strategic targeting, but they're lucky. They've got a full-time M&A guy doing nothing but that, watching the market. I do think we're going to see, we've seen a couple of these where corporates have acquired and they've not done the classic merger. Because the problem is, if you go after those economies of scale and synergy straight off, of course, you can distract a business. And if it's already growing or doing well, or the team is slightly culturally different, you in fact disrupt it and distract it. So you've got 2 change management programs going on. You've got 1, the business potentially fast tracking, and 2, then the whole integration piece. And I think we're going to see more corporates going, look, we need to buy in this emerging mid-market because we need to disrupt our business model. Buying below 50 million is low risk. So yeah, let's get on with it. But actually, let's not worry too much about integrating it overnight. Let's buy. What can we learn from the business, and we'll do that bit gently. So that's a forecast of a potential trend that we see coming through. Of course, with PE, they need to do it straight away. Digital, I think you guys all know that. Do ask questions, by the way, if I'm going too quickly. And remember, we want some questions because we need them. Otherwise, the next half an hour is going to be tough. But due diligence, every business is a digital business. We have seen early signs of people also now bringing digital due diligence to the table. I mean, it's been talked about and it's understood you should do it, but I think most people cut the corner. But I think, realizing that every business is a digital business, if the pandemic's taught us nothing but that, knowing how fit for purpose those foundations of technology, apps, IT, cyber is going to become an important part of due diligence. So I think we're going to see commercial due diligence staying there, legal, financial, but a new area, digital due diligence. And again, that makes sense, particularly if you've got private equity investing in what we call platform businesses. So that's kind of like the first one, and then looking to go and do a buy and build strategy. So what they want to buy is a fully baked business that you can bolt stuff onto, not something you've got to spend ages tidying up around compliance and technology. So we do see that as a trend. And when we work on our vendor assist work, which is helping people sort of tidy up pre-sale, typically 6-12 months beforehand, building data rooms, bench testing it during due diligence, we are looking at the KPIs, foundations, technology, cyber, as part of that, and because we see that as being key as we go forward. Okay, so big question for you guys also is valuations. We'll get there in a second, as you can see. I'm going to move there, but couple of quick forecasts from us. Sectors that we see being hot: professional services. Got a big management consultancy at the moment. We're working hard to get away. Technology, of course. Tim did a managed service business earlier in the year. SaaS, that business model. Recurring revenue, always considered robust. Again, just agreed another healthcare deal. Always again considered a robust sector. Utilities, I mentioned that this morning. We've just got a big reach out in that. So again, people looking at the safe areas in terms of recurring revenue post-pandemic. Retail is tougher, although we've got a significant online business. So I think you will see that trend continuing because, of course, online has been a big winner in the post-pandemic arena, and it looks like it's going to stick. I think also we're going to see a lot of focus back in on UK manufacture. I mean, daily we've got issues with supply chains from China. I think the whole onshoring trend has yet to fully come through, and I think UK manufacture will come back in as a winner on that in terms of M&A. In terms of private equity, the elevator deal is our typical one. So people selling out between 50 and 75%, creating a de-risk, then retaining between 50 and 10%, and or a mix of earnout for the remainder of that deal. So the earnout being on growth, maybe over the next year or two, but also retaining shares with a view, can we triple X that business? So can we buy it for 10 million and exit for 30 or 40 million? And that is absolutely what private equity are all about. We've got a couple of those at the moment. We've got one where the sort of initial acquisition value is 18 million, but the private equity are looking to put in another 15 million war chest to do the acquisitions to consolidate the space. So that's a typical elevator private equity deal. And as I say, I'll ask Tim in a minute, but I'd say it's probably 60% of the M&A activity at the moment, with trade only 40%. EOTs, we're doing more and more of these employee ownership deals where you sell the business to the employees. They are busier than the management buyout. I think that's because management buyouts tend to be over a short period and highly leveraged. And with the volatility of cash flow businesses have, that is considered high stress, whereas the employee ownership deals are much softer. You can pay them off longer, so typically on those we are leveraging the deal more often with vendor loan and third-party debt over 7-8 years. So you can get some pretty healthy values if you do that, but you can also be more forgiving on this sort of, you know, post-pandemic cash flow bouncing that we've all got going on. And because it's a vendor loan, it's much lower risk and lower stress on the business. Ultimately, if the business is in difficulty, what actually practically happens on those deals is the vendor loan just kicks out. One other thing on EOTs, and probably the big headline on it, 0% tax. So yeah, let's talk about tax. Capital gains tax, it's 10% on first million, 20% thereafter per 5% entrepreneur, depending, because we have entrepreneurs relief. There is a daily article on how it's going to go up to 40% or similar, or certainly being looked at. It's definitely going to rise. I did some quick fag packets the other day. With the corporation tax rise, the national insurance rise, the increase in dividends, entrepreneurs are already paying 8% more tax than they were pre-pandemic. If they then kick CGT up, and someone's got to pay for the pandemic, and it is going to be the high net wealths, and therefore CGT is absolutely in the frame. So, you know, tax hikes are coming. I don't think it'll be 40%. My concern with that is it will drive people offshore. But you know what? It might be 40% with some sort of retirement relief. So watch that space, particularly in March this year, and the autumn. So March coming next year, this next year, and autumn next year. I think that is the key timing. I'm an optimist. I'm hoping it's 28% because that's in line with Europe. And if they knock it to 40%, all that will happen is people will move offshore. Tim, can I bring you in now to talk about what you're seeing on the front line on valuations with your team, if that's okay? So I've got this lovely slide, which I think you're familiar with, but Tim, can you join? Maybe he
Got me out.
Ah, there we go. You're in. Tim, you're in?
Yeah, you've got my video closed off as well.
Well, that's good. No one wants to see you.
Well, okay, you could.
I'll sort that out. You start talking. I'll sort that out.
I think your first bullet point is an interesting one. This Ebitda. So we all know about Ebitda, earnings before interest, tax, depreciation, and amortization.
There we go.
There we go. That's better. With the C being COVID. What's interesting is we're not really seeing any effect on valuations. Now, it's a little too early to have decent statistics, so I am talking from an anecdotal point of view on what we're seeing, rather than many sort of market statistics. But if I take you back, Kevin referred to the sort of 08-09 recession. We obviously do have all the statistics for that. The average multiple of last full year's earnings sits in the 6s, and it does fluctuate a little, but it is very little over a long period of time. What we did see in 09-010 was deal volumes absolutely crashed to less than half pre-recession levels, and they still haven't got back to 2007 volume levels. Values or multiples did dip, but for less than a year, and came back incredibly quickly. And I think even that is a false statistic, because the statistic is based on last full year's earnings. So if you take, for example, and I'm going to keep the maths very easy for me, take, for example, a company that pre-recession was, you know, making $1 million EBITDA. Going into recession, performance dropped a bit. So let's say that dropped down to 800,000 EBITDA. They were in discussion, in negotiation. The price was oddly chipped because performance was going down. Nevertheless, the statistic is still based on last full year's earnings, which was the $1 million. So I believe that's what caused your dip in multiples, not a negotiated position. And I think we're seeing exactly the same this time round. But what we are seeing is the due diligence process being tougher, and not, the obvious one being how has COVID affected the business? How quickly will it bounce back? There is a converse situation where some businesses have benefited from COVID. So during due diligence is how long will that bubble last and when will that go away? And Kevin, I mean, you and I had a meeting only last week with a business that, coming up to COVID started selling PPE. That will fall away. They know that, and we have to factor that into our advice on what we think likely outcomes on sale are going to be.
Yeah. Do you think there's going to be a trend? Because I mean, to come back to private equity, by the way, guys, as you know, private equity typically sort of 1 million plus Ebitda kick in. Some will go lower. They do love a spreadsheet. But I had a very, very senior private equity guy saying to me that he thinks there's going to be some multiple compression going on. Now, I disagree with that due to the lack of quality stock on the market. What's your view on that? So
completely agree. It's a very, very simple supply and demand equation.
Yeah.
There are simply less businesses performing well than there were pre-COVID, and I don't think you mentioned it this time round, but the last survey of European PE money was 2.3 trillion unspent private equity funds. So this is money that has been raised that has not been yet deployed.
And I think
houses have made a commitment to their investors to deploy this money.
That's a massive opportunity. So if we've got advisors in the room, as it were, if you've got clients that have got 400 or 500k profit, if you can work hard with them, get a better management team and build it up to $1 million, that's where the energy is going to be. And it's people buying businesses with $1 million to 5 million profit. And it is much easier to scale up a business like that, whereas the startups are really tough in terms of scale up. So I think this is a good thing for the economy, because we can get it right and help those quality, as we call it, emerging mid-market. Some people call it lower mid-market, doesn't matter. Quality businesses consolidate, get more scale. That's great for the economy, and is one of the ways we're going to dig out of this pandemic trench that we seem to have dug ourselves into. Do you think that deal structure? We've had a question in here. Do you think deal structures have changed much, Tim? Looking at this,
no, not really. I think the key thing is the due diligence point. I've got one at the moment we're in negotiation on, so I'm. This isn't in the public domain yet, so I need to be a little bit careful what I say, but they have a supply chain issue. So I was working on the heads of terms on it yesterday. We have an element built into the deal which protects, so one of the key suppliers to this business has a shortage of stock, and there may be a knock-on effect there. So the due diligence process will identify that, and we have a contingent element built into the deal to factor that in. So, but that's a real specific. I think for me, COVID is simply another risk factor. Most emerging mid-market deals do have some element of contingency in them. I would estimate, say 70%, where there's some sort of earn-out, deferred payment, retained shareholding, some sort of variation on a theme, but that's typically driven by risk. And one of the biggest risks with small to mid-sized businesses is reliance on shareholders. And I think COVID is just another risk element, but we're getting to a stage where that's becoming visible. If you're looking at a target acquisition, you can now start to see what is the risk that comes from COVID, as well as the other risks that typically affect small businesses.
Interesting there. So do you think? I mean, I mentioned earlier, and again, I've got a couple of clients, so I'm not quite as in the front line as you are, Tim. So Tim, by the way, was in the top set for maths. I was in the bottom, so that's why he's MD and I'm chairman.
I cheat now. We have spreadsheets.
But I've got two sellers actually going on, and we'll come back to corporates. I've got one where a massive American PLC, and I think American money is always smart on M&A. the UK PLC is still cheap because of exchange rate, and also our multiples tend to be lower. So quite interesting that they've approached one of our sort of strategy type clients. So we're talking about negotiating that deal. Our seller was, I'm not selling this unless it's 10 million, but I think we're looking at 6 million. And he turned around and said, do you know what? Bank it whilst the tax break's there. I'm off skiing. So, and as I said to you, I've not seen that lifestyle seller so easily, because I think, you know, people just hang on longer. The whole retire out concept had removed. Are you seeing it come through, Tim? Are you getting any lifestyle sellers, for want of a better phrase, coming out?
Yeah, I mean, you referenced the managed service provider that we closed out about 4 weeks ago. The lead shareholder, although they were equal shareholdings of the three shareholders, but the lead shareholder, reason for sale was he wanted to emigrate to Canada, and he wanted to ski, mountain bike, go and live in the mountains, and that was his driver. He doesn't need to do it immediately, but he's 50 years old, just turning 50. And didn't want to get to the stage in life where he suddenly went, now's the time to go. Oh bugger, I've got this business to deal with. What am I going to do about it? So he wanted to deal with that first, and he'll you know, it'll be 4 or 5 years before he disappears off to Canada.
You gotta stay fit, skiing and mountain biking, yeah. Do that in your late 60s. That's hard work.
But I think one thing is interesting, and this is a slight divergence from your lifestyle point, but something you and I have discussed in the past around, you know, potential tax hikes and CGT and these sorts of things. And I'm wholly with you. I think the tax regime in the UK is as good as it's going to be for the next 1 or 2 decades. It can, you know, it can only go up for the reasons you've discussed. But I'm not convinced that tax hikes around CGT will be a barrier to M&A, or not a significant barrier to M&A. And my logic being is, I think sellers have a number in mind, and it's a self-validation number more than it is a I need X pounds.
Yeah.
And it's because, well, 2 conversations we have, well, 1 conversation we have regularly and one that just doesn't crop up. The number of times a seller has turned around and said, oh, I wouldn't sell for that. If I kept it, I'd get my money back in 4 years, 5 years. Well, they're wholly wrong. If you look at gross sale proceeds, that is true. If you look at net sale proceeds, 4 years turns into 7 years by the time you net everything off. That's an approximation, by the way. And the other conversation I very, very rarely have, which sellers should be asking, so we actually, funnily enough, raise with them, is what's my net position? And I think people think gross too much, and therefore there is that sort of, I don't know, almost a score chart. And please excuse the flippancy. Is you know, you can say at the golf club, or you know, whatever your social is with your mates, yes, I sold out for 10 million quid. The fact that 10 million quid is 8 million net or 6 million net, probably.
I agree with you. It's the competition with yourself that drives the number more than the number in this sector, because many of the clients have already, you know, if they're doing well for 5 or 10 plus years, you should have tucked a bit away behind you anyway. So exactly. the sale should be the icing on the cake, really, rather than the pension pot. And I think people really, any CGT hike, all that does is take away from the inheritance tax, because, you know, most people were going to sit on the money anyway, and then have an IHT problem. So frankly, it brings it forward, which is a good thing from UK PLC's point of view, not necessarily the individual, but I think that probably is the case. So, but it's fascinating how few people do financial planning and work out what their number is and work out what they really, really want. Do you remember that old method of valuation, Tim? How many shareholders? 3. Oh, 3 million.
Yeah. Any round number multiplied by shareholders, yeah.
That would be good. That used to work. Well, certainly in terms of expectations. Of course, you guys all know that the market decides a value, and it's willing buyer, willing seller. And in our case, auctions. So, most of the deals we do, the ones you're talking about, the one you're on at the moment, or the IT business, you had like 40, 50 people going after that, 5 offers, didn't you? So, that competition drives value. We've had a question here. I'm not too sure I understand it, but I'm going to interpret it in classic Kevin fashion. Do you think companies understand and take the risk? Now, I'm going to read that and say, and take risk, or take the risk to do acquisitions, because I'm not sure on the question. But whoever asked it, if you want to clarify, please do. Also, please ask more questions. Tim and I will keep waffling anyway, but it'd be great to hear from you guys. So please, can I invite more questions? So I'm going to have a crack, and then Tim, if you can interpret it, see what you think. But do I think companies understand and take the risk? If that question is, do I think they understand the risk of acquisitions? I think the answer is no. They very much rely on advisors. There's not enough board expertise on acquisitions. The advice in the emerging mid-market is also very specialist. So I've got a large one at the moment where I'm not sure that the lawyer really understands the private equity model. I've got no issue that he understands a trade deal, but I'm not sure he understands the private equity model. So, even when you're going to advisors, the quality of their advice is difficult. So I think people want to do it, but there is a lack of investment in the resources. And as a result of that, do you think companies understand and take the risk? Very often, even though they should acquire to change their business model, they simply don't, because it's all too scary. That's not everybody, but my advice to those companies: go get the right board expertise, go get the right NEDs, right advisors, do your homework, and look at their skill set and experience. It will become less risky if you invest. Tim, do you have a view on that?
Inevitably, I do. I think they understand there is risk. I'm not sure they always understand where the key risk is. And we still see, despite numerous sort of articles and surveys and what have you, and I think, to go back to a survey, and I honestly can't remember which one it was. I think it was a KPMG, but I can't be 100% sure that, when surveying CEOs who had been involved in acquisitions, those that didn't perform as well as were hoped, the biggest reason cited, and it was over 2/3 cited this reason, was cultural fit. We still see the due diligence focused around predominantly financial and legal, property, HR, all these sorts of things, but not culture. But I think there's one interesting thing to add to the cultural thing is, I don't think it means both businesses have to have the same culture. So I think the big risk is the dominant business, which is almost always the acquirer, going, our culture is right, we will change the culture of the business we acquired. And I think that can be an enormous mistake. I think respecting cultures is what is critical, rather than changing to make sure the cultures are the same. And I think if you look at most PLCs, you will see different cultures within the organization.
Getting back to now.
We'll have a very different culture from a sales department, from a marketing department, from an HR department. And I think respecting that, not forcing change unnecessary upon that, is key.
Well, so for me, your Alphabet, Google, they have retained, they've done 190 or something. I need to look it up, actually. That was last year or 2 years ago, 190 acquisitions. They've retained the vast majority of founders. And that's because they just do not impose their culture on them. They give them a vast amount of freedom to play, and that retains entrepreneurs. Whereas, the whole, and particularly, again, I'm a bit cynical with it, American buyers, reports. We're dealing with an agile emerging mid-market business. We don't do reports, we do growth. And that's a mismatch. So we have another question. When companies want to enter new markets, this is an organic growth versus acquisitions question. So when companies want to enter new markets, bearing in mind the risk of acquisitions, culture and overpaying, not getting synergies, surely the better option is just start organically. What is the reasons companies go ahead in acquisitions instead of doing it themselves?
Good question. I think that there's a sort of an assumption of risk with acquisition. And don't get me wrong, risk exists, but risk exists with organic growth as well. If you are throwing time, resource, and money at organic growth, particularly in a market, a product group, a geography, or whatever it may be you don't fully understand, I would argue that maybe that is as high risk or even higher risk than acquisition, where you are buying skill sets and knowledge of products, knowledge of markets that already exists. So I think it's a very, very fine balance. And there was a point in that question about overpaying.
Yeah.
I think that's an interesting area as well, because I think we get very fixated, and apologies because I have referenced average multiples and things like that earlier in the conversation, but I think we get highly fixated on that.
Yeah.
And I think, underpaying for the wrong acquisition, i.e., I'll buy that one because I've negotiated a great deal and the price is right and so on and so forth, is a mistake. You are better off paying more for the right acquisition that will serve your goals and achieve the objectives. Again, sorry, it's slightly flippant, but not doing so is what we call a discounted disaster.
You sound like, was that property poem? Phil Spencer, location.
Yeah. I haven't thought of it like that, but I think it's a fair point.
Yeah, I mean, I love my big corporate examples. So I think when Disney bought Pixar, brilliant, cost them 50 million, best acquisition they've ever done, because they just didn't have the IT people or IT technology. But of course, blockbusters turning Netflix down, disaster. And again, that was 50 million. In fact, I have it on authority that the CEO laughed. The CEO of Blockbusters laughed when the Netflix guys asked for 50 million. Well, I'm afraid that was a very expensive laugh. So, there's a cost of not doing a deal, isn't there?
I think there is. And I think another example, and this is a second-hand example, I'm afraid, that another corporate financier I know told me about, and he was trying to sell a business that had created some IP that had health benefits, it had environmental benefits. So on paper, everything about it was absolutely fantastic, but they weren't monetized yet.
Yeah.
And they were trying to sell this into global PLC, and the response they were getting was, no, we'll wait. We'd rather pay you 100 million when the contract is proven than pay you 10 million now and take the risk.
100% my experience with corporates, and that's the risk multiple again isn't just not worth it for them, is it? So we've had a question on CGT, 28% or even a little higher. That was my bet, of course. Do you think it will influence M&A deals? Well, we do. We think it'll bring out volume, but if it stays at 0%, will it make EOTs more attractive? At 0%, or will it take rising to 30% to have a significant impact? So the other question is it going to impact on values, the CGT? Because I can see values going up if CGT is going up, because potentially a few less sellers, although noting your point, people will crack on in the end. But also, if you're paying out a lot more CGT, you need more value for it. So what's your view on that?
I think it will have an impact, but again, I think it's going to be relatively limited. I still believe. I'll give you an example. This is a real life example. I had a potential client, and we never actually went to market in the end, who said, I want 5 million for my business. And the conversation sort of went along as, well, where did you get that figure from? Let's go and talk to a financial advisor. He was in, he had poor health. He was in his late 50s, kids within the business, and he'd come up with this magic number of 5 million quid. He absolutely refused to see a financial advisor to try and map out his financial future. And his reason was, oh, I don't want to jinx it until I got the money. I said, well, how the hell do you know what offer to accept if you don't know how much you need? And it was that attitude, it was that magic number, the reality, the net, and all the rest of it, you absolutely refused to even look at.
just a personal goal, personal aspiration.
I think it was a magic number. It was a score chart.
Yeah. So what I do think is interesting, I definitely think, so if they knock CGT up, if the EOT stays at 0%, people will run to that. They already run to it. We estimate something like 1 in 20 M&A, emerging mid-market are EOT. We've done 3 this year, we've got another 2 coming, and probably another 3 being instructed. So it's a big thing. And if the 0% stays, even more will turn to that. The other benefit of employee ownership trust is you can be more forgiving on due diligence. So the business needs to be potentially less sale ready. I'm not saying that you can leave the trustees with a really bad business, but by less sale ready, one of the areas that we're able to do, for example, is you can backfill the management. You don't have to have a fully baked management team. You don't even with an EOT have to have their permission. You can do it for the benefit of all the employees and then sell it to the management as a concept. They don't have to approve it. So basically that means owners can stay a bit longer. So I think the EOT does fulfill an important area where owners, they want a good headline number, but don't necessarily need the money. They get the 0% tax break, but also they can stay for 5 or 10 years. Because one of the other challenges, you move early for the tax break. Now you've got your tax efficient money in the bank. Where are you going to get a yield and what are you going to do? Whereas an EOT can help solve that because you stay involved. And what you're going to do is a big one, isn't it? Lots of people don't want to go to Canada and will be bored because they miss the cut and thrust of business.
Yep, I think that's very true. I think one other key benefit of the EOT is that it's not a negotiated position.
Yeah.
So you're not having that fight over numbers, the minutiae, the T's and C's, those sorts of things. That isn't there. But I think another very important point is that with an EOT as the seller, you cannot retain control. So you can't be wandering around with your size 12s and dictating the strategy of the company going forward. It is a new structure under new control.
I mean, it's a pretty niche area. So if you do want to know more, there's a really good guide on our website. There's also some webinar recordings of EOT stuff on our website. This session will be going on the website, and also you can circulate it if you think it's being useful. I will just bring us towards a close now, if that's okay, Tim. Is there anything you think I haven't covered?
No, I don't think so. I think you've covered most of the points, or at least everything that you can reasonably do in this sort of time slot.
Cool. Okay. Well, we've got some more webinars coming up. We've got private equity. We've got an event with SEMA on the business sales. So if you need any of those details or you want links or subscriptions, please do let us know. This, as I say, this recording will go out, so you can pass it on to friends as well. Tim and I, our email is there. We are very, very happy to chew the fat on anything that we've left sort of dangling that you haven't fully understood. It's how we work. We're very educative. We're very happy to talk early. So please, if you've got a question or a concern that's specific to you, reach out. We'd be delighted. I hope you've enjoyed the session this morning. Tim, thank you for your time. Really appreciated. And hopefully you all stay well. We'll catch up soon, everybody. Thank you. Cheers. Bye. Bye.
Thanks. Bye now.